Welcome back to the Daily Gold University. This is Lesson 3, Gold's relationship with bonds and currencies. The secular relationship between gold and bonds is not as uniform as that between gold and the stock market. Secular bull markets in precious metals have occurred during both secular bulls and secular bears in bonds. For example, bonds were in a secular bull market during the 1930s and 2000s, when precious metals were in a secular bull market. However, bonds were in a secular bear market in the last half of the 1960s and the entire 1970s, and this played a significant role in the secular bull market then in precious metals. There is a fundamental explanation for the changing correlation between bonds and gold. A weak economic environment with low growth, recession, and deflation risk is bullish for both bonds and gold. See the 1930s and the 2000s. However, an environment of rising inflation expectations, and low or no growth is bullish for precious metals but bearish for bonds. Consider the late 1960s and 1970s and recent years, but to a lesser extent. Gold and bonds are often more correlated than not around cyclical economic turning points. When the economy slows considerably or enters a recession, the rate of inflation declines and capital moves out of stocks and into bonds for their security and yield. Bond prices rise. As bond yields fall, the Federal Reserve elects to cut interest rates. Real interest rates decline and gold climbs. Hence, gold and bonds can perform similarly before and during recessionary and potentially recessionary environments. Circling back to secular trends, we should note that the secular trend in bonds and bond yields lasts much longer than in equities and commodities. Since the start of the Great Depression, stocks and commodities have had 6 different secular trends, while bonds and bond yields have only had 3 in the last 120 years. In the last chapter, we argue that the current macroeconomic environment is similar to the mid to late 1960s. Part of our case included the recent awakening of inflation, which also occurred in the mid to late 1960s. Bond yields are positively correlated to inflation, while bond prices are negatively correlated to inflation. If inflation has made a secular turn, then so too has the bond market. The COVID-19 crash in 2020 marked the end of the secular bull market in bonds and secular decline in yields that began in late 1981. This will have hugely bullish implications for gold and also hard assets. It has already helped push gold higher in the last few years. As shown in Figure 3.1, bond yields have only experienced one secular uptrend in the last 100 years. This uptrend coincided with a secular bear market in the S&P 500 and the best secular bull market in gold and precious metals. Unlike in the 1930s and 2000s, bonds were in a secular bear market. Bond yields began to rise earnestly in the second half of the 1950s, and bond returns diminished before equity returns slowed in the 1960s. Higher inflation leads to higher interest rates, which are negative for consumers and corporations. These economic actors face a higher borrowing cost, which impacts consumption, the cost of maintaining debt, and ultimately corporate profits. The difference between today and the 1960s, the last period inflation began to increase after many years, is that there is dramatically more debt today. According to macro trends, debt to GDP is 3 times higher today than in the mid-1960s. Also, according to RBC Wealth Management and Federal Reserve data, corporate debt to GDP is twice as high today as in the mid-1960s. In Figure 3.2, we plot gold against bonds' total return of the 10-year Treasury and gold against the price of the 30-year bond. Both have made major breakouts in recent years. Gold against bonds' total return broke out in March 2024 and is now at a 35-year high. Meanwhile, gold against the price of the 30-year bond broke out at the end of 2022, surpassing its 2011 and 1980 peaks. These ratios signal that capital is already fleeing bonds in favor of gold. As inflation ticks higher, bondholders and income-focused investors will slowly move out of bonds in favor of gold. The weakness in bonds in recent years is a significant reason why gold was able to break out from its cup and handle pattern amidst an ongoing secular bull market in stocks. Because of the debt incurred at historically low interest rates, the federal government and indebted corporations will have difficulty absorbing and enduring higher interest rates. As we noted in Chapter 2, Lesson 2, higher long-term rates are likely to end the secular bull market in stocks. The money printing and debt binge becomes a major drag on the economy and corporations only when bond yields reach a certain threshold. The likely policy option to mitigate the impact of higher bond yields is very bullish for precious metals. Many economists and investment professionals see yield curve control in our future. Under such a policy, the central bank buys long-term bonds to keep bond yields at a specific level. This is in addition to their normal manipulation of short-term interest rates. The U.S. last employed yield curve control from 1942 to 1951. Over those 9 years, inflation averaged 5.5% per year, a boon for both stocks and commodities. However, unlike in the 1940s, stocks today are not cheap and are not coming out of a nasty secular bear market. Remember 1929 to 1942. But I digress. Japan has used yield curve control since 2016. The gold price in Japanese yen terms has nearly tripled since the policy started in September 2016, surpassing gold's performance in U.S. dollars. The yen declined 37% against the U.S. dollar from September 2016 through July 2024. Although the secular trend in bonds has shifted to bearish, be aware of counter-trend moves. If the economy enters a recession in 2025 or 2026, or after a period of stagflation, bonds will rally and bond yields will decline temporarily. We move along to the U.S. dollar. Lesson 1 briefly covered gold's relationship with the U.S. dollar. In the current lesson, we will expand on that by focusing on the relationship between gold and the dollar in the context of the other asset classes. First, let me remind you of the important conclusions from that lesson. Gold leads the U.S. dollar at key turning points, and as a result, gold against foreign currencies is a leading indicator of the gold price in U.S. dollars. Finally, gold has never been in a secular bull, while the U.S. dollar has been in a secular bull. Until now. In Figure 3.3, we examine the U.S. dollar index again, this time with the important context of the other asset classes. The two secular bear markets in U.S. stocks, 1968 to 1982 and 2000 to 2009, coincided with two secular bear markets in the U.S. dollar index and secular bulls in precious metals. Similarly, most of the secular bull market in U.S. stocks from 1982 to 2000 coincided with a rising U.S. dollar. The same is true in the current cycle, as the secular bull in U.S. stocks has coincided with a secular bull in the U.S. dollar. Gold does not respond too well to cyclical declines in the U.S. dollar index during secular bull markets in U.S. equities. The U.S. dollar index was cut in half from 1985 to 1992, its worst decline in history, and gold mustered only a cyclical bull market from 1985 to 1987. The dollar declined sharply in 2017, and gold could not surpass its 2016 high. The 2022 peak in the U.S. dollar coincided with a bottom in gold. However, due to its broad strength against all currencies, gold broke out earlier this year, or earlier in 2024, I should say. Gold against foreign currencies has been stronger than gold since 2014 and 2018. Its strength in recent years was an early signal that the new secular bull market in gold would be global and much less dependent on a weak U.S. dollar. In Figure 3.4, we highlight the breakout and leading performance of gold against foreign currencies, gold divided by FC for short, from 2021 to 2023. It broke out to a new all-time high before gold did, and while the U.S. dollar enjoyed a strong rise. Chapter summary. The secular relationship between bonds and gold is not as uniform as that between stocks and gold. Because bonds can trend for 30 to 40 years, there have been secular bulls and secular bears during gold's secular bull markets. This is only the second time bonds have been in a secular bear market in the last 100 years. The last time they fell into a secular bear market, as they did after COVID-19, was in the mid-1960s. The secular bear market began in concert with the aforementioned massive breakout in gold stocks. The current secular bear market in bonds began after COVID-19 and helped stabilize gold in 2022, which helped it break out in March of 2024. A secular bear market in bonds and rising bond yields will eventually hurt the stock market and the economy. Initially, income-focused investors will move capital to dividend-paying stocks and secondarily, tips and gold. As the bear market and inflation intensify, stocks and the economy are negatively affected. Capital then moves out of stocks into tips, gold, and other commodities. Inflation and higher bond yields have yet to hit that threshold that damages the economy and the secular bull market in stocks. Hence, stocks and the US dollar remain in secular bull markets. The US dollar and the stock market trended higher together in the mid to late 1990s and have again done so since 2011. Therefore, the secular bull markets in both continue until higher bond yields hit that threshold. Do not expect the US dollar to decline significantly if the US stock market remains in a secular bull market. Gold's strength against foreign currencies over the past 10 years has recently signaled the global nature of the new secular bull market in gold. As a result, gold is much less reliant on the weakness of the US dollar than it has been in the past. Next up is lesson number 4, where we discuss what really drives silver. Thank you so much for tuning in to this lesson.